Kevin, it's a pleasure to have you here on Tech Renaissance. And first of all, I really appreciate you accepting my invite to join. I've been following your work and Jim's work for many, many years. So this is a real honor to have you on board.
Oh, thank you, Faz. I'm delighted to join you.
So I wanted to kind of share with you the theme of this channel. Generally, what we're doing here is, there's a lot of changes happening in globally in the monetary system, and I think a lot of users like myself who've been absorbing content, there's been a lot of confusion, I would say, in the last year and a half in terms of where things are heading. And I felt there were some pertinent questions that it was important to ask you to get a better understanding of where things are heading. Because for me personally, events since 2016 have started unfolding at a very rapid pace. I mean, it seemed almost like it started from Brexit. And, from there, US elections, and then every successive election globally after that, along with monetary changes, and then cryptocurrencies essentially coming up in the system, energy bonds. So there's a lot going on. So I'm here to actually ask one or two questions, but have you give us, your point of view as to what's going on. So if I could start off, if I could get your background, and then we can dive into the rest of the questions.
Oof. All right. Well, so I'm a retired military officer. Spent a misspent youth doing that. Retired in the Middle East. In fact, actually, right down the street from where you're at now. I was at the embassy in Abu Dhabi. We had kids in high school. Just didn't want to move them again, so just dropped my paperwork and retired in place. Stayed there for I think 12 years, and wound up running the Middle East for one of the big defense contractors. Was out there for quite a while. We really enjoyed it. It was a great place to do that. I was one of the founding members of the board for the first Middle East buyout firm called GrowthGate, headed up by Kareem Sawaid and his partners. Kareem's the one that ran the Donna Gas IPO. You may recall when Crescent Petroleum was going to run a pipeline from Iran over to Sharjah. And they launched that in 2005, I believe it was. And up till then, everybody thought Dubai was the capital of the UAE because it was the only thing getting any kind of publicity. And in fact, the UAE, Abu Dhabi, ran around putting little signs on all the highway signs that were directing back toward Abu Dhabi. They ran around putting little signs underneath them all that said, the capital of the United Arab Emirates. It's pretty humorous. After the Donna Gas IPO, they raised $1.8 billion in like 48 hours. And everybody in the financial capitals of the world were like, what? And all of a sudden, Abu Dhabi had a lot of attention. They kind of made their way onto the major screen. It was a great place to raise kids. Fantastic place. Right. And then I've alternated between the defense industry and back into capital markets. I was a managing director of Silverleaf Partners in Manhattan, back again as a head of international for another defense contractor. Jim Rickards and I ran into each other at a conference in Bahrain. Manama hosts the IISS, this International Institute of Security Studies, or Strategic Studies. And he and I were the only kind of Austrian hard money gold guys in the room. So you had 60, they're ministers of finance and ministers of defense. It was a pretty high powered group. I was there because I was the ranking U.S. defense executive in the region, probably. But yet it was all Keynesian kind of nonsense. It was all, I'll explain my view of the economics profession in a second, but suffice to say, I view them as modern day alchemists. And what they're talking about is just generally nonsense, and they don't know it. They're well-intended people, and they're very smart people, smarter than I am. But they're steeped in studying something that's just all completely nonsense. And so I would ask a question, and they would kind of harumph and get uncomfortable. And Jim would laugh, right? I'm like, oh, I like that guy. I'd read his book, Currency Wars, so we just struck up a conversation, and we talked a little bit about Project Prophecy. Anybody that's read his work knows that after 9/11, the CIA asked him to help create algorithms that would scan global financial market data and look for those kind of precursors, those kind of indicators that there might be another terrorist attack coming, right? And the intent, of course, was could you see it in enough time that you could get a warrant, kick in a door, frustrate the attack, that sort of thing, right? Well, it worked really well. It was based on Bayesian inference, pretty much a core staple of the intelligence community. What Jim and I have done is we've taken that original model And we've added behavioral psychology, computing with words, textual analysis, history, historical perspective, and complexity science. And we have built an engine that basically lets you see the future. I mean, it looks magical, but it's like Arthur C. Clarke had a great phrase. He said, any sufficiently advanced technology is indistinguishable from magic. What we're doing is not magic, it just looks like it. But that's a short background on me. So Jim and I created Meraglim. We run this company. It's a tech startup. And basically it allows our clients to see the future 3 to 6 months in advance on major macro events.
So Meraglim Holdings, I mean, could you describe your model? Is it a algorithm that goes out? I recently interviewed Cliff High, who has Webbot, which is a more of a predictive linguistics algorithm that searches the web. How is your your technology different? What exactly does it entail?
Yeah, the major difference is that it's team science. So the disappointment that people have had with artificial intelligence is that while it's artificial, it's not that intelligent. A machine can't tell the difference between sense and nonsense. It can't tell you if Ben Bernanke or Janet Yellen have a better perception of how the world actually works than Jim Grant or Stephanie Pomboy or Pippa Malmgren. It just can't tell. It can tell you consensus. It can tell you that Yellen or Powell's positions are in the consensus, right? But it can't tell you if they're just nonsensical. It has no way to tell sense from nonsense. What we've done that's completely different is we start with the human narrative. We start with subject matter experts who actually understand how the world works. We take their work, we explode that narrative out from its conceptual components, its causal linkages, you weight the edges between them. Now you've got something that looks something like a constellation map of all the connecting ideas. Now you've got something you can turn over to a natural language processor like IBM's Watson, who's our partner in this. Now they can ingest 9 million books, articles, transcripts a day and update every one of those nodes and edges and concepts in real time 24/7. It's a job you and I couldn't hire enough analysts in the world to maintain that model, to keep it updated, right? Mm-hmm. But the computer can't build the model. Only you and I and a team of really, really bright subject matter experts can build the model, right? But only a natural language processing, kind of a neural network and all the other capabilities a Watson brings can actually maintain it in real time, right? It's the combination of human and machine intelligence that make us so different. Then our complexity science runs over that, 1,000 times an hour. What you have out the other side is what's called a footprint of uncertainty in the complexity science. But for you as a client, what you get is a real-time, updated 24/7 analysis of exactly what's happening with all the inputs. So even if you disagreed with me, for example, one of our outlooks right now is that China is going to have to devalue the yuan in a fairly significant way, probably around 20%. Even if you disagreed with my outlook, if you were a client, you'd have 24/7 access to everything I know. It's not a black box. Our algorithms are proprietary, but the data, the inputs, it's just open market feeds, right? Mm-hmm. It's just the Watson feeds being pushed back to you in a form where you can just click one of those nodes, you can click one of the edges, you can click one of the conceptual components. You're going to get it'll pop up with a full screen, everything we know about it, all the latest inputs to it, why we've weighted it the way we have. In fact, by what percentage did we give it Bayesian versus complexity versus behavioral psychology versus history? How did we weight the analysis? And so in real time, you can disagree with me. You'll still have way better data with which to do your analyses. So anyway, that's what Jim and I've done.
Excellent. It sounds really intriguing. So based on that, I guess I'll just dive, since I assume a lot of the data will be at a global macro
That's right.
scenario.
That's
and
right.
So, can you walk us through what's going on in the monetary system? As I mentioned to you earlier, that since 2016, ever since Brexit, it's become increasingly difficult for the average investor to essentially assess which way trends are going, and all traditional correlations, essentially are not yielding the results that one wants. So where do you see things going? in the coming year?
Yeah, no, I see it exactly the same, and there's a reason for it. It's not obscure. It's quite obvious. But we are so accustomed to thinking of governments and central banks as quasi-sovereigns, as almost omniscient, as almost omnipotent, that we forget first principles. So here's, if you and I were mathematicians, economists in the Soviet Union, and our colleagues are all brilliant. They threw some of the best minds they had to throw at this problem. What we were doing was taking stacks of paper before computers. We had stacks of paper and pencils, and you'd be like, hey, Kevin, what should milk cost? I don't know, make it X. How about iron ore? Make it Y. Right? They were setting prices on goods and on goods and services. 2 million light items a month with pencil and paper, and trying to run an economy like that, right? In 1922, Ludwig von Mises called that out in a book called Socialism and said, here's why this must fail. And it had to do with divorcing yourself from price signals, right? So we all know that in real life, markets are just a gigantic auction. They're just a gigantic clearinghouse of information. You get up every day. I'll buy this. I won't buy that. I won't buy anything today. Maybe I'll buy this. That's expensive. I'll buy this instead, right? That those billions of decisions made by all your fellow countrymen globally filter into a vast market, and all of that data is communicated through price signals, right? It's how you know what to study in college. It's how you know what business to start, what business to close, what to charge, what not to charge, right? Signals matter. Those price signals matter, right? What the central banks and governments have done, they're more efficient. So now they're not doing it with stacks of paper and pencil, right? Although you've got individual governments trying it. So for example, if you and I were on a city council and some clown next to us says, you know what, milk is just too expensive. The poor can't afford milk at this price. This is terrible. Milk should be 50 cents a gallon, right? Now, we know what's going to happen, and we'll fight this on the city council. But if there's enough knuckleheads that don't know how to do math and don't know basic economics, we're going to get overturned, and they're going to declare milk's now 50 cents a gallon, right? Okay, well, we know what happens the next day, right? There's no milk on the shelves. It's gone, right? If you and I are dairy producers, we can't produce milk, have it delivered for 50 cents a gallon, right? The price was what it was. So all that happens is milk's just gone. Everybody knows that price controls turn out like that, except unless you're a knucklehead in Venezuela or something and want to relearn that lesson. Then you flip it on its head. Then you get city governments that think, oh, no, we can manipulate the price of labor. So we're on a city council in Seattle, and some knucklehead goes, you know what, the poor are suffering. Minimum wage is too little. That's not a living wage. This should be $15 an hour. It should be 15. Now, again, we'll argue, we'll fight. But either they're illiterate, innumerate, they can't do math, or they're corrupt. They know it's going to throw all these people out of work and don't care because they think it'll buy them votes from low information voters. It's tough to know, causality. They pass a $15 an hour minimum wage law, just like milk flying off the shelves. Every job whose labor's not worth, every employee whose labor's not worth $15 an hour just got legislated out of a job. You just made it a crime to hire it, right? So unemployment pops, right?
Right.
Exactly. A couple months later, the people in Seattle are like, oh, well, we didn't think that was going to happen, right? Because they're morons. All right. I tell you that because it's important to remember first principles when we come back to governments and central banks, because the rules are the same for them as well.
I remember in Manhattan, in New York City, when they imposed minimum wage, especially a lot of the fast food chains and restaurants switched to iPads for placing your orders. So it just, ultimately the individuals got disrupted.
All they did was get thrown out of jobs, right? You made it a crime to hire anyone whose labor wasn't worth the arbitrary cutoff you made, just like you made it a crime for us to deliver milk to shelves, right, above your arbitrary price point, right? It's the same manipulation, and it always turns out the same way, right? So my point to bring to laying that groundwork is that every government, every central banker is doing the same thing. And unlike the Soviets, who were trying to do it line item by line item, you've got the exact same principle, the exact same practice now applied to a single item. But it is the one item in which everything else is priced. They're manipulating the price of the currency itself. Mm-hmm. And so they are trying to do the exact same thing the Soviet economists did from their command and control top-down economy that blew up. And now our Western central banks are all doing exactly the same thing, and they're losing control of it. So to your point, there are no markets. That's why you're not getting any market signals. You got 5,000-year low bond yields, 0% interest, negative in some places in Europe. I mean, that's insanity, right? That is people so desperate, they don't know what to do. And so they'll turn their capital over on a 100-year bond in Argentina. Are you kidding me? They defaulted 4 times in the last 100 years. What makes you think it's going to be different in the next 100? Right? That is just sheer idiocy. But central banks think that by monkeying with the interest rates, they can somehow control the economy. The problem with that, one, it's just simply false. But and I can prove it to you really quickly. If you and I were sitting in a conference and we heard some guy get up and start talking about he and his friends had studied Yosemite, this great national park system in America, and they got a plan. They're going to fix it. They're going to make it better, right? They're going to dial up a number of the badgers. They're going to dial back the number of bears. They're going to make it more efficient. We'd start laughing, right? Are you nuts? That's a complex adaptive system. You can't tweak it. You can't make changes at the margins without having a cascade of feedback and unintended consequences. You have no idea what's coming, right? That's the nature. That's why people don't tweak on the margins of hurricanes or forest fires, right? These are complex adaptive systems. And yet, we listen to central bankers get up and talk about dialing up a little inflation. They're going to dial down some unemployment, right? They're going to make the economy better, right? They're going to protect unemployment. They're going to protect currency. I mean, it's just sheer idiocy. It's an hubris, Hayek's fatal conceit on steroids, right? And yet we're so accustomed to hearing it, we don't even notice anymore. We don't laugh out loud, which is what we should do, or reach for torches and pitchforks, which would be an even better response. We just blithely go along, and now it's all unraveling. It's all collapsing around us. That's why you're not getting any kind of market signals. It's why it's pushed markets into high-frequency trading algorithms, just trying to find a way to eke some kind of return. You've got passive investing that's got massive inflows of capital because a bunch of people are looking at it going, wow, the Fed's got our back. It's magical, right? Why would I give money to you and pay fees? I can, the Fed's got my back. I get this magic put. Things always go up, right? So what do you think is going to happen to all those people that put their money in these passive vehicles that have no consideration for your individual requirements as an investor? They have no diversification. So most of them, all of them, are overweighted in the FANG and other things, right? So they're all tied to the same handful of stocks. And 3, that buy no matter what the price, right? How do you think that story is going to end, right? So you get all these people sucked into this passive investing trap that's going to kill them. You got the handful of actual money managers now, that relatively few compared to the volume on the exchange. I think less than maybe 15% of the market's actually traded by humans now, right? Those people are desperately looking for return. So they're chasing correlations, regression, mean reversion with high frequency trading and other tools. That's a race to the bottom, spending ever more capital on taking latency out of their trades, another, millisecond out of their turnaround time. Again, it's a race to the bottom. This will all end very badly. It'll end with a global reset of currencies against gold, which it always does. It has no choice. The whole crypto phenomenon is a perfect example of that desperate search for value, right? So just like the algos and the quants all turn to better math and better, faster systems trying to eke an advantage, in my opinion, the crypto world is the same thing. It is a desperate search to get away from fiat currencies produced by governments and try to find value apart and distinct from that, because they understand that's bad, right? The problem is they're not too far enough removed. cryptocurrencies, like national currencies, are still just fiat currencies. There's nothing behind them except confidence, right?
Sure.
Now, confidence can carry it for quite a while. It's carried the US dollar for 40 years beyond its sell-by date, right? And this isn't inevitable. It didn't have to be this way. The Ottoman Empire retained the world's reserve currency for over 800 years. Very simple process. Be honest. Don't try to steal value from your people and your trading partners by devaluing your currency. So for 800 years, the Ottomans, first the Eastern Empire and then the Ottomans, maintained the value of the precious metal content of the solidus coin, right? Imagine that. U.S. couldn't do it for 40 years, right? We couldn't, we were devaluing that dollar as fast as we could, still do. Right? Since 1971, the U.S. dollar's lost 97.3% of its value. So if you held dollars, you had $1 million in 1971 and you left it in T-bills or currency, you've been destroyed, just wiped out. That's not an accident. That's theft under color of modern banking theory. It's just theft.
In fact, in this environment, what, and maybe I'll pick your thoughts on this. When we're there's deflationary monetary systems and there's inflationary monetary systems, and inflationary monetary systems, which that we've been in since 1971, essentially your value, you have to go out and beat inflation consistently in order to actually preserve value in your purchasing power. So the current system we're in, it was a lot easier to assess this when we were, I would say, 5 years away, 8 years away. But as we've approached 2016, it's getting increasingly confusing to see when this, essentially, if the reset is going to happen, when this will happen. Is it? Right. Do you think it's a process or is it an event? China just launched an energy bond price in Yuan. I know there was a lot of hype about that. I wanted to get your thoughts on that as well. I personally believe this is a gradual process where different countries are gradually exiting out of one currency or another. I think all governments around the world are playing the same game of fiat, but they're just gradually hedging and creating their own value. So, what is your take on how this process is going to unfold?
So, first thing on inflationary currency systems, you've reversed causality. So they have to inflate the money supply because under a fiat currency, all currency is created by debt. All money is created, and I won't call it money. All currency is created by debt, right? Well, if you create currency for debt, whence comes the interest? You're going to pay that back, right? You have to create more currency just to create the interest. So it's inherently inflationary by its own nature. And it's that inflationary push that pulls prices and everything else along, right? That's all responsive. So, right, if you and I are playing Monopoly with some friends and the banker steals himself an extra $1 million, guess what happens to the price of the next property we bid on, right? And the prices went up by $1 million. He wins the property. We get screwed because the value of our holdings were just diminished by that, right? So that's inherently inflationary in its system. When you said deflationary monetary systems, absolutely. If you tie your currency to honest money, over time, you will have a slight deflationary effect, which we saw all through the 1800s. And the reason for that is because gold and silver are mined, gold in particular, is roughly recovered from the earth at about a 1.5% increase to total gold stocks, which tracks quite nicely to human population growth. So gold, if in just slightly deflationary. So things priced in honest money will tend to come down over time. This is horrible for governments because when prices come down, your standard of living rises, but the government's got no way to tax that, right? They want the inflationary environment that they can tax, even though your purchasing power didn't increase as much as the nominal value of the currency. They still get to take additional chunks of your currency, right? It's a great game for them. The second reason they can't afford a deflationary environment is they're massive debtors, right? And if if currency begins to gain in value in a deflationary environment, they get wiped out. They are just destroyed, right? So they have to have inflation. Now they make all kinds of noises about why it's a good thing. It's just a scam. It's just theft. It's just so. Since 2016, it's starting to accelerate. Will it be gradual? That's what they all hope. They're all trying to manage a process. Will they succeed? I really doubt it. I mean, they want it to be gradual. Nobody wants to see the dollar overturned overnight because a lot of those governments, China included, are holding huge piles of treasuries, right? And have an economic interest themselves in seeing that a gradual process. But China is, so ask yourself, if you had $3 trillion in foreign currency of a country you didn't trust, you thought was your antagonist, that you could tell was trying to devalue that currency to get out from under their own debt obligations as fast as possible, what would you do to hedge that risk?
I do what China is doing.
You buy gold, hand over fist, right?
Buy gold and also convert the...
And then you start looking for ways to trade with people away from the dollar, right? Well, China's doing both, right, as fast as they can. So they're buying gold as quickly as they can get their hands on it, which is a hedge against the dollar's collapse. So at some point, when there's a great reset, gold will go to $50,000 an ounce in US dollars. Their treasuries will drop, their treasury holdings will drop, but their gold holdings will be revalued. They'll be fine, right? So that's why Russia, China, everybody that's got a brain is buying gold as quickly as possible, trying to get ahead of that reset because it's inevitable. It has to happen.
China, in fact, I mean, you're experiencing this in Pakistan because it's the first of the One Belt, One Road. The first initiative is called CPEC. And so one of the initiatives that they've done is basically they're taking, like you said, the treasuries they're sitting on, and they're now turning into the debtor, essentially offering credit to these developing nations that don't have infrastructure. And a lot of these projects are build, own, operate. And so essentially they're hard assets with better IRRs than the yield on the treasury.
Absolutely.
So they're hedging and they're getting better yield. So they're winning the current game in the current system, and they're hedged in case the system goes away, right? Or essentially.
And they're building a network over land that is less capable to be interdicted by U.S. naval forces, right? So they're securing their economic overland routes better. I mean, yeah, no, it's nothing but smart. You know, as we used to joke, China's got more kids in honors classes than we got kids. So they're massive. So your individual investors watching this, I'd warn there's two things that come up. There's two kind of mental biases that can get you really hurt. The first one is normalcy bias, the idea that, I've been hearing people wink and carry on about this for years. You got Harry Dent's worried about a deflationary collapse, and Jim Rickards and Peter Schiff and Massengill are talking about a hyperinflationary. Who's right? I can't tell, right? It's never happened all this time. And what's the odds it's going to happen tomorrow, right? That's the first one, normalcy bias. The second problem you got to think through is learned helplessness. This idea that these are really difficult topics. When Powell and Yellen and Draghi speak, they sound like they know what they're doing. Who am I to challenge that? And they want to sit back like they're a 7-year-old in the backseat of the car on a stormy night. You look around, you're nervous, but you see your dad's driving. You're like, he knows what he's doing. You just go to sleep, right?
That's a great
remembers that view, right? Well, I can tell you that as a citizen, as an adult, government's not your parent. They're not the adult behind the wheel. In fact, you're in the backseat of a car on a stormy night, and there's nobody behind the wheel. If you understood how little these people understood about how the world really works, you'd be panicked. You'd understand these people have no idea what they're doing. And they get up and they do their press conferences and they blather on about stochastic equilibrium models and value at risk and blah, blah. I mean, it's all garbage. It's just nonsensical. So what your listeners need to think about is there are no adults behind the wheel. They have to think for themselves. Normalcy bias will get you killed because there's a great reset coming. And when it happens, every asset that's denominated in currency or has its value tied to currency will be destroyed, will be wiped out. They don't want to do it. It's a failure, but they won't have any choice. They will lose control of this, and it will just happen. And they'll either cause a war, they'll find some excuse to blame, an outsider, so they're not the one responsible. But it happens. It will happen here. And so you need to get your assets into safe havens. You need to have some holdings in precious metals, gold and silver, not in electronic form, but in bullion, not necessarily held in your hound or house, but there's vaulting services, goldmoney.com, bullion vault, you can have them stored, but you don't want to have electronic counterparty risk. Pension funds, stocks, derivatives, all of that will come unwound. And now what remains doesn't go away. What remains are the private businesses, the farms, the feedstocks, all that stuff's still there the next day. None of that just vanishes. It's not Mad Max. It's just a massive transfer of ownership, a massive transfer of value. And so if you're the average person with a little bit of money set aside, you've got a pension from the government, you think the pension's still going to come, but it won't buy lunch. They're going to honor the debt, but they're going to destroy the currency it's paid in. Right. And so the more you can get your assets into precious metals, income producing real estate, apartment buildings, or agricultural production, the more you can get to primary wealth, the better you're going to be coming out the other side of this. And you and your family will be fine, and you'll have some capital to help rebuild your neighborhood and society and whatnot and get started again.
Kevin, if you could kind of break down primary wealth for us in terms of, sure. I know it's, agricultural land that has yield, real estate that has yield, gold, sure. silver, and mining assets, but, just
let's think about it, from a category. So you have three types of wealth as I see it. You have primary, secondary, and tertiary. Primary wealth is what God gives us. So think, cattle on the field, fish in the sea, coal, oil in the ground, right? That's what God puts in place. That's primary wealth. Secondary wealth are what we do with it, the output of our mixing our labor and capital with those elements. So we turn cattle into beef, we turn fish to feedstocks, we turn oil into power generation plants and electrical production, et cetera, right? That's secondary levels of wealth. And again, that's not going away either. Tertiary levels of wealth are what emerge anytime you have sufficiently cheap energy. Societies always develop into this more advanced stage. And I don't mean to say it's negative or bad. Derivatives contracts, I'm sure, have their place. Futures contracts have their place. I think they had futures contracts in Babylonia, right? So any sufficiently advanced society with sufficient energy reserves will develop into this ever advanced system. The problem is that's the system that gets wiped away. Those are the assets that are all at the tertiary level that are all tied to currency and that get blown away in the economic storms and the reset. So imagine if you and I run respective governments and this all starts to melt down, how do we trust each other's currency? How do I know? Let's say you're running Pakistan and I'm running the US. How do you know what a US dollar is worth now? How do I know what your currency's worth so we can trade, right? We're going to have to default back to some store of value that's common to everyone that everyone can trust. So the gold standard will emerge not because they want it, not because a bunch of PhDs decide to finally relinquish power. These mad scientists fooling with the entire world is a great experiment because they're just insane and drunk with power. It'll happen because the market demands it, because we won't have any other choices. We won't trust each other. You'll have to take your currency, show what you've put into the world, divide that by the gold holdings that you show. That's what your currency is worth. I'll have to do the same. We'll go back to a default gold standard just because nobody will trust anybody else to not do what America just did by destroying the world's reserve currency in order to milk a value, steal value from it, right? Nobody's going to trust the Chinese not to do that. So people talking about the yuan replacing the dollar. Nobody's going to trust the Chinese to do any better than the Americans just did. What you're going to come out?
There's a loss in confidence.
Basket of currencies. Gold will play a major role. So the better you can get your assets either in precious metals or tied to things like apartment complexes, like income producing real estate that can react with price changes, you'll be fine. You'll be okay. In fact, you'll come out really well. But people who have their wealth tied in a frothy stock market that's going to just explode, bonds are at their lowest of 38 years. That's got nowhere to go but up. We're in the all bubble, everything bubble right now.
Right. Absolutely. I'll transition here into cryptocurrencies because I think 50% of the wealth that came into cryptocurrencies were individuals that formerly held silver or gold, and essentially, a lot of them were just tired out because they kept on waiting for, as you know, it's a patience game because you're competing with the monetary system resetting.
Right.
I myself, what I did was I didn't reallocate any precious metals positions, but I took my paper asset positions, which were stocks primarily, and reallocated them into cryptocurrencies. And there was a thesis there for that.
Sure.
If you look at the actual protocol and the of Bitcoin and Litecoin specifically, it seems that there's an attempt to create a digital format of gold and silver, and whether it's a group of people or an individual. There's an attempt to capture the sentiment that would have gone into gold and silver into a digital format, which, I do agree with you that ultimately gold and silver is the pure form of money. And this, again, is a currency. But, it seems like there's an attempt that with an awareness that, if a reset comes, it may be a lot easier to drive individuals into this mechanism versus going into gold and silver, which, sovereign governments would want to essentially hoard up at that point.
Yeah, no, it's interesting. I find it fascinating that every time you see a physical representation of Bitcoin, it's always a picture of a gold coin.
Right. Exactly.
I find that really makes me smile every time I see it. So gold, so to be considered a currency or function like money, it has to have a number of characteristics. Bitcoin has most of them, except two. It's not unlimited. People pretend that it is. The problem is you can always have a future branch and sequel like you've seen others do, and there will be other cryptocurrencies that emerge. So the idea that that's somehow finite is, I find a little specious. The second problem is it needs to be a store of value, right? So it's a unit of account, and it's a unit of trade, a way to clear trades. That's true. But it's certainly no store of value, right? If it swings as wildly as it swings, that's not a store of value. That is a speculation. So as long as you go into it, eyes wide open, knowing that's what you're doing, and the rest of your portfolio is predominantly in safe haven assets that can't be just destroyed, taking a small portion and putting it on the highest, most speculative things you can find, that's actually a good trading strategy as long as you know that's what you're doing, right? Mm-hmm. So they are highly speculative investments. I don't think their long-term future is bright for a couple of reasons. One has to do with the technology. The power generation requirements to make that network function are not sustainable. The time it takes to clear transactions means it's never going to replace Visa, MasterCard, instant point of sale kind of capabilities.
So some of that stuff, so Kevin, again, I come from your school of thought. And so the Lightning Network is, one of the components of what, and again, this is why I say there seems to be support from the system. Digital Currency Group and has a ownership from NASDAQ, New York Life, and NASDAQ and MasterCard. And a lot of these entities are funding the Lightning Network, which essentially takes the decentralized nature of Bitcoin and Litecoin and essentially then processes the transactions much more rapidly. And so actually the transaction time, if they are ever able to implement Lightning Network, are supposed to shoot up to about 1 million transactions a second, versus 25,000 on Visa and MasterCard. So, again, like I said, I do believe that gold and silver are true forms of money, but at the same time, I believe there's an attempt from the stakeholders of the existing system, cognizant of the fact that, that we will have to go to a deflationary standard. It's almost like there's an inflationary and a deflationary system that is being created simultaneously with Ethereum, which is predefined inflationary coins. Bitcoin, Litecoin are deflationary coins. They have a finite limit and they have to be mined.
Right.
And then obviously this is in technology in its infancy. So there's improvements coming. And then the biggest factor I think that's important to consider here is that most of the individuals going into cryptocurrencies are millennials. And essentially they have lost that connection because ever since we de-linked from gold in 1971, I mean, I actually find myself to be a minority when I interact with intelligent people, and there's no connectivity between gold and currency and money and that particular understanding. Being from Asia, I mean, at least, there's some level of understanding that, hey, gold has some value. But generally, when I speak to my counterparts in the West, there's just no understanding there.
Oh, sure. That's right.
The younger generation, I mean, especially in Asia, I mean, you've got demographics here that, in some of these countries, 60% of the population is below the age of 30. So again, like I said, it's just a thesis, but the interest level that I'm seeing in Asia in cryptocurrency, especially from the younger population, not the older generation doesn't get it. Even myself, I'm at the cusp in my 40s. Most people don't get it, but the younger generation is going after it. And so we may be in a split two-tier system in the future.
So if you think of it as a currency, which is what it is, right? It's no different than a Mexican peso or an American dollar. Most of the world's fiat currencies are all cryptocurrencies, right? There's vastly more digital dollars than there are real paper dollars, right? Vastly more. So the US dollar is a cryptocurrency, right? So to the extent that it's a platform to buy and sell, fantastic, sure. Will it provide a store of value? Will it provide a safe haven? Can you put $1 million in it and know you're going to have $1 million worth of purchasing power 20 years from now when your kids are getting ready to go to college? Absolutely not. Absolutely not. So, but that's okay as long as you understand its value, its actual application. Its actual application as a trading mechanism, as a currency to buy and sell. Fantastic, great. Just don't imagine that just because you bought a bunch of it and it went up violently, it will always go up and you'll be rich because you're just a genius in a bull market, right? It's a speculation. That's all. Is it brilliant? Yeah, absolutely. Does the libertarian side of me just sing at the idea of anything that divorces, human beings and governments from economic activity? Absolutely. I think that's fantastic. Do I think governments are going to stand idly by and let all of this transaction pass them by without taking their cut? No, I don't. So right now, if you bought Bitcoin at $200, you turn around and you buy something for $1,000 because Bitcoin climbed rapidly.
Capital gains.
There are governments somewhere that think you owe them tax on an $800 increase, just as if you had a stock that increased, right?
Right.
And there's a whole bunch of people that are going to find out the hard way that governments are really serious about getting their cut. And your pretense of anonymity, you're about to learn governments are more powerful than you think they are. So
I don't buy the anonymity component of that. Anything that's digital is not anonymous.
Correct.
The underlying infrastructure.
Yeah. So, and then the next fear I have is that governments will, now that people have bought in mentally to the idea of a pure cryptocurrency, will shoulder them out, just make them illegal, just declare you can't trade or buy or sell them, or you're the equivalent of a terrorist or cocaine dealer. They'll come out with some 2 or 3 weeks worth of propaganda about, this is just being used by terrorists and bad people. And, the typical sheep in the middle, of the country will be like, oh, okay, yeah. Right. They'll just make it a crime and they'll announce their own cryptocurrency. And now you're in a situation where governments have total control over you, total oversight. They know everything you're doing, where you're at. If they decide you're an enemy, they just turn off your digital accounts and you are well and truly screwed. That is way more of concern to me than anything else. But so I find it interesting that libertarians, people who at heart want to have distance from government and be out of their control and be left alone to do their own business and buy and sell without interference, are actually putting themselves into a digital concentration camp. At the end of the day, they should at least maintain 20% or so of their assets in precious metals held outside their own country, so they've got options. That's the best I could say about it.
I mean, I think the lesson to take from here is that one is diversify, especially out of paper assets into real assets.
Right.
Number two, have it in multiple geographic locations. So to protect yourself from that systemic risk, because governments, I think it's not as if governments are evil. They tend to react. The bureaucratic setup will protect itself.
Correct.
And serve rights till the end of time to survive. And I think that's why it's important to spread wealth in multiple geographic locations, all within the gambits of the law.
That's right. That's right.
And I think most of us are bound to partake in the paper system because we receive remuneration in paper assets, and many of us are bound by our 401ks or stock options.
Right.
But again,
which can be put in precious metals, by the way. I've done that.
Right. Can you? I've read up on that quite a bit, and I never. Can you guide us a little bit on that? On how is that possible? What type of?
It's perfectly legal. So call a company called Entrust, ENTRUST, Entrust. They are used by goldmoney.com, the great vaulting service, right? And they're perfectly compliant with U.S. government. So I rolled my 401k into an Entrust managed 401k, no tax obligation. You don't take the money, right? You just roll it from one account to the other. And they rolled it into a goldmoney.com account, and I purchased gold and silver with that. And so I have separate bullion accounts. One's part of my 401k that I don't touch or spend that otherwise I pay a penalty, right, for early withdrawals. But it's all in bullion. It's all in bullion currency held outside the U.S. So for me, that was well worth doing because 401ks would be just wiped out.
Absolutely,
just seize them. They're doing it
in other countries.
Yeah, that's right. They'll make you buy treasuries because that's safer for you, right? That's what they'll do. I mean, it's just garbage. When you think about a confidence game, when you think about how all currencies began, they all began as receipts, warehouse receipts for actual gold and silver held somewhere, right? So all currencies began as just a warehouse receipt, every one of them. They were just a paper representation of a receipt. It was like a claim check for your shirt at the cleaners, or your suit at the cleaners. It wasn't the actual suit. It's just a claim check, right? But you can walk in with your claim check, turn it in, get your suit back, right? And so pretty soon, rather than hand the suit around to people just started trading the actual claim check, right? Okay, fine. Still, the suit's still hanging on the rack. That's fine. The problem was, as soon as they figured that out, bankers figured out, oh man, you know what? I can create fake claim tickets for suits I don't really have, charge you for that. You won't know any better. What are the odds everybody comes back to get the one suit I got hanging here and I'm busted? What are the odds of that happening, right? So they flood counterfeit chits into the world, get paid money for that. That's a great game. It's just a great game. And then they buy off enough politicians. They do a central bank cartel to protect that individual bank from ever being caught in their fraud, right? Because you want to run on banks. You know what a run on banks are? Run on bank is just when people figure out the fraud. That's all. And they give it a fancy name, fractional reserve lending. In what other endeavor in life can you pretend to have ownership to things that don't exist and charge people money for the right to it, right? How does that work exactly? Right? How can multiple people have a legitimate legal claim to the one suit hanging on the rack? They all got the ticket. How does that work? It's called fraud in any other business, right? And it will end the same way all frauds do, badly. And the people who, the one guy who gets in there first and actually gets his suit, fine, he's great. everybody else is screwed. You don't want to be everybody else. So at least a percentage of your assets, take the little claim tickets that they give you at your work and convert those to real assets as quickly as possible, because there's nothing behind that claim ticket anymore. Just your experience that it worked yesterday. Sure, it'll work tomorrow, right?
It's just a confidence. When confidence goes, it goes very rapidly.
Correct. And the fact that Bitcoin's emerged with such force, to me, the greatest signal that cryptocurrencies provide is they reflect everybody's understanding. Even if it's dim and they're not fully thought through, they understand there's a real problem with those currencies. I need to get away from that, right? It's not maybe fully formed, and maybe they're not, they haven't thought that all the way through, but they're not comfortable with that system. They're looking for something else, and they're putting their money somewhere else. That's a real vote of no confidence in the world's current fiat systems. And those systems are backed by nothing but confidence.
Absolutely. Kevin, I wanted to get your take in the end on geopolitics, because obviously the monetary system and ripples in the monetary system translate into geopolitical events and geopolitical alignments.
Sure.
Something, where I'm sitting in this part of the world, there's been a major shift. And given that a lot of the energy of the world comes from this part of the world, you've seen suddenly Qatar separate from the GCC, with Saudi Arabia and UAE and Bahrain moving to the other side.
Right.
Essentially, Qatar's aligned with Iran and Turkey. What exactly is going on? And where do you? I mean, and China attempting to come through Pakistan and connect with Iran in order to price this bond in renminbi, which is to price an energy bond in renminbi, which may eventually be convertible to gold. There's all sorts of different perspectives out there. I wanted to get your take on what's going on here.
So all nations try to pursue their best advantage, right? That's what they're supposed to do for their people, right? So if you kind of take a macro view, all governments want to stay in power, right? So they're desperately trying to show, even if we think of them as a dictatorship from outside, inside there's still a constellation of power that they have to balance and that they have to assuage, or they're going to be thrown out of power, right? So when you watch these moves, just know that it's two things going on. It looks like it's external. China's interacting with Pakistan. A better way to think of it, it's the Chinese leadership interacting with countervailing Chinese forces inside the country, and they're using these external relationships to bolster their power, right? It's always more nuanced than it looks. Don't think about countries as unitary actors. What does Israel think? What does the U.S. think? Really? Are you kidding me? I mean, it's just hugely. Ask yourself better, why does the current leadership think this is a value for them? Value meaning they get reelected or they get to stay in power for doing this, right?
Right.
That's a better way to think about it. So Xi has consolidated power in China very efficiently.
Right.
What that probably means is a great repression now, a great tightening of control, because he's not going to want to risk that control, right? So you're actually going to see a real lockdown on China. And they have massive debt problems. So is there an alignment shaking out around the world? There is. Is there another great war coming? Yes, there is. I'm a big fan of Strauss and Howe. I recommend your readers check out a book called The Fourth Turning by Strauss.
I've read it. Excellent book.
Okay, so you know where we're at in that cycle, right? We're 18 years into the winter phase that generally only lasts 20. So we're going to have almost certainly a major war. Currency destruction, debt liquidation, and war almost always terminate this part of the cycle, the final 80 years. And it's nothing more than all the people who lived through the trauma of the last Great War are died off and gone. And the people that are now in control in their 60s and 70s weren't even born during the last Great War. You know, it's a history thing to them, like Reagan is to my children or John F. Kennedy is to me, right? It's just kind of an element of history. It's not quite real, right? So we're going into this next Great War. What you're seeing are the maneuvering for advantage of who's going to be on what side. And I think it's inevitable. I think the French have a really good phrase for this. They call it the logique de guerre. It's just this idea, the logic of war. And it's just this idea that at some point, the world's leadership just become resigned to the fact that war's the only solution, right? And then it just kind of propels itself on down those tracks. It's how they're going to clear their debts. It's how they're going to wipe out their currency and restart. I mean, look at the antagonism right now toward Russia, both by the U.S. liberal Democrats and by Theresa May in London. There is an agitation to try to go to war on just spacious grounds, right? The chemical compound that was used to assassinate that guy can be made by any chemist anywhere in the world in his garage. There's nothing magical about those compounds. They're just organic chemistry.
And this happened many, many years ago, right? The spy there.
No, the one just a couple weeks ago. There was an assassination attempt on a Russian former double agent and his daughter, I think.
Right. So, okay.
But the idea that you can tell that's Russia, therefore it's time to go to war. History will look back at that and just roll their eyes. Really? If Russia has enemies, and they do, let's think Ukraine. If I'm a clever guy running black ops in Ukraine, why wouldn't I kill that guy, make it, roughly look like the Russians? Wouldn't that be of value to me? Right? I mean, the idea that this is so obvious and can be determined instantly is just silly. It's just absolutely silly. But my point is, there's this rush to war. There's this rush to make things worse, to throw out each other's diplomats and to accuse each other without evidence, right? The reason they're doing that is because they think they have no choice. They think they need this war to get out from under everything that's going on. They hope it'll be short and sharp and brief. And, Abe Lincoln wrote a note to a friend that he hoped there'd be a small little conflict so they could get this all resolved. 650,000 dead later, a small conflict didn't work out quite that well. But, they may not mean to be as evil as they are, but they are. So the war's coming almost inevitably. Currency resets are coming absolutely inevitably. And your listeners should position themselves and their assets accordingly, and not worry about the timing. The timing's best thought of like an avalanche. If you're at a ski resort, if you and I run a ski resort, we go out and we look at the snowpack, we can tell that's unstable snowmass. That's going to come down. It's going to kill everybody on the slopes. We either close the slopes that day or we go do what professionals, throw dynamite or shoot cannons at it or whatever it is they do to make that thing go ahead and come loose, right? The question is not, can I calculate which particular snowflake is going to trigger the avalanche? No, I can't. We're not God. We're never going to have that kind of data, right? We're not omniscient. But it's the wrong question. The better question is, can I look at the unstable snowmass and know what's coming? Yeah, I can. And that's the situation we're in. We don't have to know what's the trigger event. We don't have to know what's the final snowflake to know how this story ends, right? With massive currency reset against the value of gold, take the gold the country holds, divide by the currency they put into the market, and that gives you a rough approximation where that ends for you and your currency. In the United States,
so how much gold is, because the official figures seem very low for China, Russia, but I do know that they're hedging with gold. And what are at a very broad, high level, what are the percentages that each country is holding?
Well, that's a really closely held
larger,
secret in China.
Right.
The best analysis that I've seen done believes that China probably has something on the order of 20 tons, which sounds like an enormous amount, but that's about what the United States had at the end of World War II. The U.S. claims to have 8,000. They've never allowed an audit of that since the 1950s, so nobody knows if that's true or not.
I think Mnuchin randomly last year just came out and said, "Hey, I went to Fort Knox and all the gold is there," which I found very odd. Why that statement was even needed.
Okay then. Yeah, isn't that that's just silly, right? I mean, that's just embarrassing. So Jim Rickards thinks the non-deflationary indicative price of gold is about $10,000 an ounce. He said that a couple of years ago, so it's actually probably closer to 12 or 13,000 now. Another way to do the math, and he's doing that based on 40% reserve coverage, which is what we did, I think, around World War I. We went back on a gold standard briefly. A better way to think about it is, in a panic, you get one-to-one coverage. And so in 1973 or 4, a man named Jim Sinclair did the math. Gold had gone from $35 an ounce, spiked to 200, retraced 50%, was at 100 at the time. People were ready to throw themselves out of car window, out of the building windows. They were just panicked, right? And he's doing the math, and he goes, okay, well, here's how much gold you have. Here's how many dollars you printed in. It's going to go to a one-to-one coverage. Gold's got to go to at least $850 an ounce. And people thought he was insane. I mean, it'd been $35 an ounce their entire lives, right?
Okay.
And $850, are you insane? It hit $850, stayed there for a month, less than 5 or 6 years later, right? And you could buy the entire Dow for a single ounce gold coin. Now, Jim Sinclair, chairman of Tanzania Gold, still out there, did the same math, same guy. Said, looked at the numbers and go, okay, gold's got to go to at least $50,000 an ounce. And again, it sounds fantastic. It sounds insane, right? Gold will retain its purchasing power. What that really means is your dollar's about to be hyperinflated to nothing. That's what that really means. People always think in terms of their national currencies. They fail to think in terms of gold, right? Mm. For example, most people think Berkshire Hathaway is doing great. Look at it nominally. It's, $300,000 or something a share. It looks fantastic. Most people don't realize that priced in gold, Berkshire Hathaway lost 70% of its value from 2000 to 2012. 70% of its value, right? You and I couldn't build a house if every day we came to work, all of our workers had rulers that changed lengths every day, right? 12 inches is not 12 inches tomorrow, right? We couldn't build anything like that. And yet the world doesn't notice that they're pricing things in this ridiculously elastic current measuring units that change value, over and over and over.
I always say that it's like it's not real estate going up; it's the currency devaluing.
Correct.
That's actually, real estate is capturing that devaluation each year.
They're reflecting it. That's exactly right. That's right. When you see a stock market, frothy-looking stock market bubble that looks fantastic in the U.S., except it's barely a third of its value that it was in 2000. So it took 44 ounces of gold to buy the Dow in 2000, right? Today, you can buy the entire Dow for, 16 ounces of gold. People think, the market's doing great. Really? In monopoly money. I mean, there's a reason why the world's greatest stock market for years was Zimbabwe. Right?
Right. 2000. I'm thinking Venezuela 2013, but
exactly right
before the hyperinflation.
For me, this is the proof that Donald Trump and his people don't understand economics any better than Obama and his socialist clucks around him. He understands that deregulating an economy is better and lower taxes are better. He gets that. Clearly, he's a businessman. But he doesn't understand the economic risk we're in, or he'd have never taken credit for that frothy stock market bubble.
Right. He called it a bubble in the election campaign.
And he was right. Right. And then as soon, he was under so much pressure from all the assaults on him that he wanted something good to point to. And he used the stock market and said, hey, look, see, my policies are working. Yeah, that's right. Your policies cause a bubble in the market to continue to froth because people like the deregulatory story, they like the lower taxes story, but that doesn't change the underlying nature of an economy that has no earnings. You have share buybacks jacking up earnings per share so people can get their bonuses, buying back their own stock at its all-time high price, using debt to do it. This is going to be an epic disaster when it corrects. And it has to correct, right? Nothing goes up forever. And
Right.
And he should have said, I'm happy to see the bump in the stock market. Yes, people are responding to a lower regulatory regime and preferential taxes. However, people don't lose sight of the risk, right? Our fiscal house is not in order. We owe almost $100 trillion in debt. We have $20 trillion in debt that we admit to in short-term amounts, and we're going down almost $6 trillion a year. They lie about the deficit. It's not a trillion. It's actually $6 trillion. And GAO numbers, not mine, GAO just takes the unfunded pension liabilities out, put it in footnotes, and say, oh, it's $1 trillion. Okay. Well, if you do normal GAAP accounting, like we would hold any country to, any company to, and you put those back out of the footnotes, back into the normal, if you and I have unfunded pension liabilities in a company we run, that's our balance sheet. We don't get to just take it off the balance sheet and put it in a footnote and pretend it's not there, right? Under normal GAAP accounting rules published by the U.S. government, the U.S. is upside down $6 trillion a year. Okay, well, how long do you think that's sustainable? How long do you think the world's going to continue to take U.S. dollars for goods and services?
A lot longer than I thought possible, frankly.
Me too.
I think and part of the reason is, what you were saying, just like as when that generation that fought the last Great War dies off, right. I think that same generation is the generation that actually has recognized the value of money versus currency. And I think that's an important component because most of my peers, most of the younger generation that I come in contact with, they have no concept of what money is. It is probably the most important thing, the currency is the most important thing that they deal with on a day-to-day basis. Right. Yet they have no idea how it works. It's not being taught in schools properly. Right. I think even if you study finance in college, if you major in finance in college, you're not really taught much about the money system.
That's correct.
It's kind of a very quick, thing to move on to bonds, stocks, and other assets. So,
right. So you got a generation carrying claim checks for a suit. There's only one suit, right? And they're all carrying the same claim check for the same suit, right? And they don't understand that. They think that's money. It's not money. It's currency, and it's backed by nothing. It's a confidence game. And you think the government's got your back because of FDIC? Okay, well, they've got like 0.07% of reserves. So they couldn't pay back 2 people out of all the millions they claim to have coverage for, right? They don't have any money.
So what happens when if a crisis brews? I mean, I know Jim's talked about something he called ICE 9, where they freeze the system, and then some of what we've seen in Greece and Cyprus,
exactly,
and some of these other countries. And then there's also constantly a push, war on cash, which we saw in India as well, where they demonetized gold. Kevin, where do you see, I mean, just so the average individual can understand, I mean, how do you see things going in the next 6 months, 12 months, 18 months?
Yeah, I actually think this is the year. I really do. I don't see how this is sustainable beyond this. So for the average person, you should get a box of silver, throw it in your closet, and forget about it. Silver is so ridiculously cheap right now, right? Absolutely. Historically, it trends between 30 and 15, ounces of silver to an ounce of gold. Way back historically, it was more like 12 to 10, but for a while, let's say it's fluctuating around 20. Today, it's 81? It takes 81 ounces of silver to buy an ounce of gold. That is insane. So to the folks that have got some extra money laying around, go buy silver. Trust me on this. You'll be very happy you did. Don't get fancy. Don't try to buy bullion. Just get bullion coins, right? The local mint, your country's bullion coins are fine. The reason for that is not just for a great store of value, but in a crisis, when ATM machines don't work or when ATM machines are rigged down so you can only get your $100 a day or whatever it is the government allows you to have in a crisis, you'll still be able to buy and sell. And it doesn't take It doesn't take an EMP blast from a rogue North Korean regime or a Mad Max scenario. Look at Puerto Rico, right? Had a horrible storm, a fragile infrastructure. They still don't have power in vast parts of that island, right? And without power, there's no trade, there's no commerce, there's no credit cards at work, there's certainly no Bitcoin, right? You want to have some coins that are of intrinsic value, and you can buy groceries with that. You can, you keep your family together for the couple months it takes to sort itself out. So I would make sure you have access to fresh water and some food in a closet, and throw a box of silver in the back of your closet and forget about it. And you have some options. And then I would just start a rigorous plan to get my assets into 80 to 90% of my assets into dead safe things that can't blow up, and take the 20 to 10% and put them on the biggest high flying. You want to place 10 bets on 10 different new cryptos? Great. But know that you're doing that for speculative purposes, and know that the rest of your assets are dead safe, and you're not going to wake up with counterparty risk.
You just defined my portfolio allocation. It's basically the 20% in crypto is basically the same that I'd written off anyways, sitting in stocks. And so I moved it there. And the rest is all in actual, either agricultural land, commercial real estate, or residential.
Yeah, you're doing what all the smart money in the world is doing. That's now they're not putting money in crypto, but they've moved their assets away from tertiary assets. I mean, look at Buffett. Look what he's buying: rails, pipelines, hard assets, right?
Exactly.
He's sitting on $100 billion in cash because he doesn't trust the stock market valuations. He just can't buy things at a good value. He's going to wait, right? You should put yourself in the same position. I wouldn't hold cash. I'd put that into, he's not either. He's rolling that over in, 28-day T-bills kind of thing. But I would tell your folks, do what Buffett does. Don't do what he says. Do what he does. Right. Get your assets into hard primary wealth assets, and take your speculative portfolio, place it on the coolest high flying things you can find, and that's a good barbell strategy, right?
Absolutely.
Don't worry about when. You just know it's coming. You don't care.
Right. You can't time these things.
You don't care. Right? It's people who think they can figure it out and get out ahead of everybody else. Really? So think about the high frequency trading model, right? Right now it's rigged to buy the dip because the Fed's got our back, right? What happens the day all those algorithms flip and decide it's time to sell the rise at the same time in microseconds? And they're 80% of the market, right? There is no market. You won't be able to exit at all. The market will limit down day after day after day until they close the markets under a national emergency, and you're stuck. You will never exit that. You're not going to beat the high frequency trading algorithms, period. And there's a day coming when they decide, and they're going to figure it out before you. And then there's going to be no exit for you because there'll be nobody else to buy the other side of that trade.
And Kevin, and again, I've never dealt with high frequency trading or ever actually developed a model professionally. I wanted to understand. I mean, aren't gold and silver the actual alarm bells for the economic system? So I would assume a lot of these models have them baked in that if gold spikes, silver spikes, time to offload risk assets because it's indicative of a geopolitical event. But obviously, given the shorts, excessive shorts that are placed on gold and silver through the London LBMA, that's the figure that these models are looking at, right? They're not looking at the physical.
So if you and I were doing it, yeah, that's exactly how we do it, right? Do I have any confidence these people understand how the world works? No, I don't. I have no idea what their algorithms are tied to. In fact, I mean, look right now what you've got. The world's completely disconnected. You got VIX, you got volatility at all-time lows. Nothing shakes this market. You've got the market's rolling over, but the tech stocks, the FANG, are the ones driving the lift. That's unsustainable. You'd have to hold one of those stocks, I think, 250 years to break even? Really? That's clever, right? I mean, it's just insanity. At some point, the market's going to wake up, though, and go, maybe the Fed doesn't have this under control, right? Maybe we need to get out of this. And when that happens, the idea that you somehow are going to beat that herd to the door is just laughable, right?
Yeah.
Because there's 80% of them, 20% of you, they trade in microseconds. They've spent a fortune taking latency out of their trades so they can beat each other's algorithms, right? They're not worried about you calling Charles Schwab. You're not even, you're a guppy in the system. A muppet actually is what they call you in the circles. So the real problem, if you're an institutional money manager, you have no choice. What's the old joke? If the music's playing, you got to get up and dance, right? Well, that's true if you're managing other people's money, right? They're not paying you fees for you to sit on the sideline and protect their cash. They can sit on the sideline and protect their assets. They don't need you for that, right? So if you're a money manager, you have no choice but to dance on increasingly thin ice, listening to it crack. You have no choice. That's your business model. And you're going to go through the ice at some point. It's just that's the way the world works. Your listeners, though, who aren't constrained by that, quarterly performance requirements, they're not going to have their jobs taken, they're not going to be fired, can ignore all of that. Literally ignore all of what they're doing. Those people have no choice. They know what they're doing is dangerous. They have no choice. The assets are going to be taken away from them if they don't continue to play this stupid game. You don't have to do that. So you right now, as an individual investor, gold and silver is getting ready to take off, silver specifically. The grains, the commodity grains, they're effectively free. You should put, if you wanted to play that game, get into that, right? And you don't have to buy the actual grains, buy companies that are in that space. But the grains are getting ready to just take off. Bonds are about to die. Equity markets are about to die, especially in the developed markets. Maybe in the emerging markets, some of them will do better than others. I don't know that game that well.
They're fairly correlated now, equities markets, I think, globally. I mean, we're also interconnected.
It's hard to imagine that, the U.S. and Europe can roll over and not affect them, right? I mean, it's just hard to imagine. So I don't do anything in equity markets except defense stocks and natural resource stocks. Because even though the market as a whole can roll over, if you've got assets, solid, well-ran companies in the agriculture space, in the primary wealth space, they'll be fine. They'll be fine. There's a reason why homestead mining went up 1,300% or something, all during the Depression. Today it's Barrick Gold, I think. Right, it was the biggest gold miner in the U.S. So you can be in the market, just don't be in sectors that are tied to tech or tied to currency. Don't be in the financials; they'll get destroyed. But be in primary wealth generation, food production, agriculture, metals, mining, grains, that sort of thing. You'll be fine if you want to stay in the markets at all. And then bonds will get destroyed. And in my opinion, the cryptocurrencies will be destroyed by governments that want to usurp control. They'll want to capture that value. They'll want to capture the taxing. And so they will just make up a story, make them illegal, come out with their own version of a cryptocurrency, and which just terrifies my libertarian heart. But that's the path I think we're on.
It makes sense. I mean, some of the, the numbers, if gold goes to $10,000 an ounce, then we're looking at essentially $500 an ounce silver.
Oh yeah, you sure could. Yeah, absolutely.
Which is what, $17 an ounce? That's like trading
16.
like cryptocurrencies, literally. Similar type of returns.
But it literally, that's no different than what happened in the 70s. No different.
Right. Absolutely.
Right. So it's just all playing out again. And in my opinion, it doesn't stop at 10. I actually think Jim Sinclair's got this right. I think the panic will cause it to balance, which means gold goes to $50,000 an ounce. Silver could go to what? $10,000 an ounce. Can you imagine? And when that happens, a couple things will happen. One, you won't be able to buy anymore. It'll be done. Those markets will be closed to you, right? Sovereign wealth funds, governments will be able to get some gold and silver you want. It'll be gone. What'll happen then within a couple of months, you'll see a great shift into the precious metals miners, right? You'll see them start to take off because that's where people can go. They can still buy stocks, right?
Right.
So you'll see them get into that game. So even after precious metals peaked, I'm thinking in 1980, you saw precious metals equities continue to rise for like another 18 months, as a kind of an echo effect. So when you see that great bull market, if you had assets in it, great, sell around the top best you can. If you miss it, get into precious metals equities, but know that that's going to be short-lived, right? That'll only last maybe 18 months or so. But if you can exit around 50,000, then pull your, get your cash back, right? And immediately go back into stocks, right? Go buy Berkshire Hathaway. It'll be down 80%. Right. Then you can go buy some apartment complexes, buy real assets, put a little bit in the stocks, maybe 20%, because there'll be bargains to be had. You'll be able to buy the entire Dow for about 1/2 an ounce of gold at that point. And that's great. I mean, so look at the numbers, right? You read the fourth turning. So if you look at a chart of the Dow priced in gold, you see this perfectly illustrated, right? This 20-year cycles. So, and it's enough for your listeners. If you haven't read the book, it's nothing more than think about how your grandparents or great grandparents were colored by the Great Depression, how they treated cash and mortgages, and it just colored the way they viewed the world. And then they raised their kids, and there was a small backlash to that, and they raised their kids and a small backlash to that. And there's this 4-generation kind of archetypes that just work their way through. And you can see it in the Dow priced in gold. So in 29, it takes 12 ounces of gold to buy the Dow. Right? The Dow's at an all-time high in 1929. 4 years later, 1933, you could buy the entire Dow for 2 ounces of gold. Right? And remember, gold's at a fixed price this whole time. It's $20 an ounce. 1933, they reset. They devalue the dollar by 70%. They seize all the gold first. They get the cream of that. Then they devalue the dollar against gold after they took gold back. 1966, you have the big stock market boom ends. It takes 24 ounces of gold to buy the Dow at that point. If in 1966 you sold all your stocks and bought nothing but gold, holy shit. By 1980, you could buy the entire Dow for 1 ounce of gold. The Dow went down to 770, gold went to 850. Right? So $35 an ounce in 1966, $850 in 1980. You could buy the entire Dow for 1 ounce of gold. Okay, great, good. Sell all your gold, go back into stocks and real estate. Because 20 years later, in the summer of 1999, gold puts a double bottom in, can't break through 250. It's been 20 years. The cycle's got to turn pretty quick. That's your signal. Sell these crazy tech stocks. Everybody knew it was a bubble. They just didn't know when to get out. Thought they could all race the exit, right? Just like we were talking about. You'd know to get out. Watch the price of gold. It hit 250 the summer of 1990. Tried again. Couldn't pierce it. That's it. Time to sell all your stocks. Go all in gold. If you'd have done that in the summer of 99, you'd have avoided all the catastrophe of the 2000 blow up, which, by the way, it took 44 ounces of gold to buy the Dow that summer. 44. You could buy the entire Dow for 1 ounce gold coin 20 years earlier. Today, it's 44 ounces of gold to buy the Dow, right? In the summer of 99. Sell all your stocks, go all in gold, right? Now look what happens for the next 10 years. Holy shit. Gold goes from $250 an ounce to $1,900 in less than 11 years.
Yeah, I think the peak of that bull market was August of 2011.
Yep. Then it retraced 50%, right, roughly. And now it's taking off again. And now it's going to go to the moon. And so read The Fourth Turning. You'll understand what's causing it all. It's not an economics book. It's actually a social phenomenon. It's nothing to do with economics, although it impacts economics. Look at the Dow Jones price in gold. Look at that chart and ask yourself, where do you think we're going next? 2000, 44 ounces of gold to buy the Dow. By 2009, you could buy the entire Dow for 7 ounces of gold. 7. They throw $4.5 trillion of fake money at the problem. It gets you a dead cat bounce all the way back up to, 16 ounces of gold, I think. right? And it's already
It's what the Dow is roughly, what, 23,000 right now?
in US dollars, nominal. Okay. Yeah, it's whatever it is. It looks like it's double, right? In year 2000, it was 11,000. So it looks like it's doubled, right?
You're spot on. I'm calculating 17.16 ounces. Very close.
Okay, right? But in the summer of 2000, do the math, right? You had $250 gold, right? It was 11,000. Took 44 ounces of gold to buy the Dow in the summer of 2000, summer of 99, right? 2000. All right, so by 2009, it drops all the way down to 7 ounces of gold. $4.5 trillion later, you're at 16, 17 ounces of gold. You're still nowhere near the 44 ounce.
44.
Even though in nominal terms, it looks like it's doubled. It's not doubled. It's down by 2/3. But it looks like it's doubled, right? Because you're counting it with a measuring unit that changes shape and size every day. You're like the builder trying to work with a yardstick that gets to decide how long it is every day. Right? So look at that chart. You see the dead cat bounce from 9 ounces of gold up to 16 or 17. It's already starting to roll over, right? And you know where this goes next. It drops like a stone over the next 2 or 3 years. It'll be safe to get back in the markets when you can buy the Dow for 1/2 of an ounce of gold. That's how you'll know. It was 2 ounces in 33. It was 1 ounce in 1980. It'll be a 1/2 ounce in 2018, 2019, 2020, whenever it happens. And you can see it on the chart. Just draw the lines. It's oscillating because of the Treasury, the insane central bank currency flooding. But the lines are straight as a string.
Kevin, that's actually the first time somebody's actually given me a plan on, because it's always like, hey, go into gold. I'm like, okay, I'm waiting. I'm in gold. Well, what do I do? And you've actually,
what do you do now?
like you explained the cycle, which is a much longer cycle. And it's like, look, it's simply, you got to sit it out, wait till it gets about 1/2 an ounce, roughly, or an ounce of gold.
Right.
Basically get back in. So it's not like you're saying go into gold and never come back out.
Correct.
Obviously, you always want to keep some level of gold.
Yeah, but I would keep less than 5 or 10% after the turn, right?
Right, exactly.
Gold hits $50,000 an ounce. You can go buy Berkshire Hathaway at that point. Oh my goodness, right? It'll be down at least 90%. If you wanted to do nothing but go play tennis and not have to think about these kinds of things, liquidate your gold, put 1/2 of it in apartment complexes in different countries, right? And in companies that manage apartment complexes, you don't want the headache, and put the other 1/2 in Berkshire Hathaway and go on vacation. You got nothing else to think about. Leave 10% of your assets in gold and just every year rebalance, right? And just stay because for the next 20 years, you got nothing to worry about. You got nothing to think about. It'll take 20 years for gold to, drop down in value. 20 years later, you'll be looking for the double bottom in gold. Stocks will be in a frothy bubble. Everybody will know, but they won't know what to do next or how to get out of it. You will, or you'll have told your kids, right? And, okay, around this year, start looking for a frothy stock market bubble. Start watching the price of gold. When it puts a double bottom in, liquidate your stocks, go all in gold. It's an actual plan. I learned it from reading the fourth turning. Nikolai Kondratiev saw it. He didn't understand what was causing it, but he saw the phenomena, these 20-year cycles, 18-year cycles. And it's just nothing more than what happens when the next generation comes of age, right? That's all. It's nothing magical. It's nothing astrological about it or moon phase or anything. I love Cliff White, but he gets out there a little bit sometimes. It's got nothing. There's no woo-woo to this. It's just how human beings react, and as they go through life, your values were different at 20 than they were at 40, and then they will be at 60. It's just, and there'll be economic impacts because of that. That's all.
Absolutely. It's a confidence and a sentiment game, right? And that sentiment changes based on your age and your experiences in life.
Absolutely right. That's right.
Kevin, thank you so much for your time. This has been really illuminating for me personally, and I'm sure for the viewers as well. And I look forward to having you again back in the future because I'd like to keep this conversation going.
Well, yes, great questions. And it was a real pleasure to get to spend time with you. Thanks.